Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today, we're going to go through Twitter, see what people are sharing on social media, looking at what the data is being shared with everyone else. It's generally related to three different topics: wealth building, commodities, and or financial topics. So let's just dive in there. Let's take a look, see what people are sharing. If you want to follow me, at Finance. If you want to join our community, finding-value.com is where I dive deeper into all these sectors, looking for individual companies, looking for investment opportunities in the market that are cheap, that provide a whole bunch of upside leverage. Mayday coupon code still is active. So coming on down, Burns Co. Stock markets are absolutely on fire yesterday. Canadian TSX at the close, August 15th by sector. Remember, if rocking all-time portfolio highs, always nice to have some available cash. When not so great, you have arrived as an investor when you get nervous at highs and salivating on lows. There is truth to that. Now look at the S&P Select Sectors heat map. I wanted to go over that. We've got energy up 22%, materials up 20%, oil and gas up about 20%, energy staples 19.66. Now, what's underperforming is telecom services, TSX Venture, diversified banks, real estate, healthcare, utilities. This could also mean where we're at in the cycle. Materials and energy do very well in a late stage expansion phase of real estate. And if these start to break out of their patterns, which they've got big patterns, energy's been consolidating since 2022. We can see a big breakout if we do get a breakout in oil and energy stocks. So very interesting that they are starting to outperform, and we're real close to breaking out a lot of their patterns, and some are already breaking out. They look really, really good. HFI research says low prices are curing low prices for natural gas. Thanks to the price dip, lower 48 nat gas production is dropping rapidly. TILs are being delayed to November, December. The market needs this to balance the bloated storage. So we need production to come down because I know we've got a lot of inventory. Well, what caused that high inventory? We had 2 warm winters in a row that has bloated our inventory levels. We are still using more natural gas for electricity power burn, but those heating seasons haven't really taken away the inventory. We've had 2 warm winters. Around the world, they've been warm, not just certain little areas, but 2 warm winters for the entire world. And if we do get a cold winter, it'd be very interesting to see where natural gas prices actually go if we get large inventory draws. We could see natural gas be very volatile. And I think with the setup that we've got, we could also have this weird setup where we start to get production to pull back. And if we get a cold winter, you have to turn back on production real fast. So it'd be interesting to see what natural gas prices do when we've got pulling back production and if we get a really cold winter, whenever that winter does come. The S&P index is pretty much going up 7% per year for 100 years. And the US dollar currency supply has been going up 7% per year for 100 years. What you have is a basket of assets that are holding their value in real terms while they trend up in nominal terms. Yeah, they're just holding their value. That's all they're doing. And that's what gold does too. Gold goes up about 7%. So it's just all these assets going up with the money supply. And that's how you have to protect your purchasing power. But here's the problem. If your S&P goes up 7% and the real inflation rate is 7%, well, you have to pay taxes on that. So who's winning in this game? Well, it's the government who wins because they steal 7% from the currency and they take 15% of your 7% quote gain out of your S&P index. Yeah, it works real well for them, I guess. Brandon Balo says China is buying silver hand over fist. As my friend Cuppy likes to say, just front run whatever China is buying. And they're buying silver. So here's China's silver imports. Look at the record level here. They are just ripping the silver imports here. much higher than any time in history going back to 2009. So China's buying silver. That's what they're doing. Grady says the commodities bull market should last at least 10 years from the 2020 low. It is and will be glorious when central banks move from hiking in QT to cutting yield curve control in QE. Plus, the bull markets in general equities and bonds are history. Global capital flows into the space will be more than historical. And that's the full setup there. That's what we're in commodities for. Commodities is where the value's at. And the money, where the money is at currently, is where things are overvalued, which is technology stocks and the S&P 500 historically. So yeah, we're going to get a little bit of rotation from those sectors into commodities, and that's what's going to drive the big bull market in commodities. Javier, this is ExxonMobil, and I was talking about those setups. Could we get a break higher here in ExxonMobil and a lot of these oil companies? Some are already peaking out above their resistance lines in certain areas. So this is what we're looking for. We're looking for crude oil to break out. We're looking for ExxonMobil and the equities to also break out. We haven't broken out yet on average, and there are some leaders that are starting to break out already that are mid-cap, small-cap companies, which is pretty cool. Neil Jacob says, why do you think so many smart people are still skeptical of Bitcoin? Well, I'll name a couple of things that make me skeptical. I don't know if I'm a smart people, but this is why I'm skeptical of Bitcoin. Bitcoin has only existed under one market condition, under a recovery phase of real estate, which was low inflation and low interest rates. As we start to move upwards in interest rates and as inflation starts to take a better stranglehold in the economy, I'm curious to see how Bitcoin reacts to that new market condition. The expansion phase of real estate is generally inflationary, and that's what we are entering. Bitcoin and technology stocks, which I think Bitcoin is just an extension of technology, and only being able to witness it for that one portion of the cycle, I am not convinced yet that Bitcoin will go up in an expansion phase of real estate or under high inflation. I'm not convinced yet. I'm also not convinced that Bitcoin can separate from technology stocks. So that is where my skepticism comes for Bitcoin. I also have further skepticism of Bitcoin because Bitcoin is literally nothing. And there's no reason that I have to use Bitcoin. Another thing that makes me so skeptical of Bitcoin is that there's a finite amount of Bitcoin. The problem is, what happens when the price of Bitcoin goes way down in a different market condition? If the different market condition, aka inflation and higher interest rates, if we see a tech crash and we see a Bitcoin crash, what will save Bitcoin? So if the mining costs continue to go up and the price of Bitcoin goes down 90% with the NASDAQ, what are the miners going to do? And how much are the fees that are going to be attributed to those making transactions? If the price of Bitcoin is $1,000 and your fee to mine the Bitcoin that is put to each transaction, let's say is $3,000. Would people do transactions if the fee was $3,000 to trade a $1,000 Bitcoin? If the fees get so astronomical? Is the design by humans going to stand the test of time? Name one thing in history, one thing that has lasted hundreds of years that was designed by man. Every government has failed. Every currency that has been created by man has failed. Every design has failed. Every house has fallen over over 1,000+ years. I mean, maybe there's some castles that are still up, but for the most part, everything that man creates disintegrates into dust. So, what makes you think that Bitcoin is the real deal? What makes you think that the design of Bitcoin can stand the test of time? And that's where my problem lies. There's only a handful of companies, technology companies, that really went through the year 2000 and exist today that are bigger than what they were back then. Most of them failed. So if Bitcoin is an extension of the technology sector, and most technology companies fail over long periods of time, I would probably guess that most or all cryptocurrencies will fail over time. Now, Bitcoin probably has one of the best chances of being a survivor, but I don't know. I don't know if it will survive. So my reluctancy and I'm skeptical of it because of it only existing in one market condition, and it being rooted with technology stocks, and it not having to go through a different market condition yet. I'm skeptical, and I don't like Bitcoin because I don't think it's a great design. I think the design is not. I don't think you can make a digital currency perfect, and I think that there's flaws in every digital currency that is created because there's things that humans have to, decisions that the designer and humans have to make it work, which is flawed. Cross-border capital, our latest research piece explores the implications of the stronger Japanese yen and potentially weaker US dollar. Was a secret deal struck? Consider the 1985 Plaza Accord triggered a global liquidity boom. Could history rhyme? Watch the DXY. So this is a long-term cycle here in the 80s. It peaked in 82, 83, came back down, bottomed in mid 80s, 85 and a half, came back. And it's running something very similar to 2019 through maybe 2017 at the end here. And that is this liquidity, long-term cycle, global liquidity coming up and coming down on that long-term cycle. Looks very similar. So maybe we have an upswing here very soon in global liquidity. Rock bottom entry says miners are breaking out on all time frames. The monthly is indicating we're on track for a parabolic move into quarter three, quarter four. This next leg higher will be the euphoria stage of the cycle, in his opinion. And what he's got here is underneath the X that I can't read. But this is moving on higher. I think it's the mining companies. Looks like it's Arca or something. And we've got a breakout here recently. So it looks pretty good. Looks pretty good. Lumber prices. So breaking, lumber prices have declined to their lowest levels since the 2020 pandemic, down 80% in 2 years. Lumber is a leading indicator for the U.S. housing market, global economic conditions, and inflation. The rapid drop in lumber prices suggests that the U.S. residential construction and home improvement markets are sharply slowing. This has been reflected in the new home construction data, which plummeted in June toward a 4-year low. Additionally, single-family housing starts declining their fourth consecutive month in June to a 1-year low. The housing boom is slowing. Here's my beef with this, guys. So lumber prices work when it's like a car. Okay, so you've got a car, your car is idling, and you've got your cooling system. Lumber is your cooling system. Now, what occurred here is you had your car, it's running, and you're on the highway and you accelerate, and it's really hot out. What happens is your temperatures could creep higher as you're accelerating and accelerating. Maybe it's a high boost car with a bunch of pressure, and your temperatures start to go up. This here is a legit signal. It's going because what it's doing is the housing market is exceeding your capacity of lumber supply. So prices rise with lumber. But when you get over to the right-hand side, look at all this volatility that we got. They shut down production. That's like disconnecting your cooling from your system, your engine, starting your engine back up with no coolant in it, and then saying, we have a huge demand for lumber. But it's like, yeah, but you just screwed the demand and the supply. Like you messed the system up. So this coming back and normalizing where the system, the coolant flow is coming back into the engine, we've restored the problem in the cooling system. It's going to come back to an average. And this here was a totally messed up lumber price because of what we did to the supply side when we stopped it during COVID. So when it comes and normalizes, everyone's like, "Oh, the market's crashing." It's like, no, it's normalizing. Like, how do you know that this is crashing necessarily? Because lumber prices went down from an astronomical high when we shut down the supply side. I think things are normalizing here. And yes, things have slowed down for housing starts, but this is also normalizing to some degree. Now, if we were down here at 200, then I'd be like, okay, maybe we do have a problem if we come all the way back down here. But right now, I think we're just normalizing. I think this is a weird setup that occurred. Here's an update chart approaching the COVID lows again. Frustrating, but on positive divergence. This is the commodity to stock ratio. Look at this double bottom here. Usually you come down, you come to an area that you draw a trend line across, and this is the bottom, and then the second bottom. I call that the booty bottom. And maybe we can get working on up again. But commodities are at incredibly cheap levels here. Incredibly cheap. Investment wisdom, we've got Charlie Munger's 5 investment skills to develop. This is important. Number 1, the ability to keep raw, irrational emotions under control. Number 2, practice patience. Number 3, discipline. And these all go together. The ability to keep irrational emotions under control is part of patience, which is also part of discipline. Number 4, an ability to take losses and adversity without going crazy. Number 5, the ability to not be driven crazy by extreme success. Those are the 5 things that you, as an investor, need to develop those skills. Eric Nettles says, Walmart CEO, so far we aren't experiencing a weak consumer overall. What weak oil demand? Question mark. And this is 2024. The big 3, crude oil, gasoline, and distillate inventory levels are below the average. And we're towards, 2023. We're pretty close to 2023. We're pretty close to 2022. And we're pretty close to 2018, which is all on the low side of inventory. Another one from Eric Nuttall says, Battle of the Barrel, financial demand for oil as measured by open interest is at an all-time low versus physical demand for oil as measured by global oil inventories at an all-time high. So financial demand is at all-time lows at the same time that physical demand is at all-time highs, or inventories are at all-time lows, however you want to say that. Very interesting mix here, and I think that's a huge opportunity in oil. I'd like to see oil price break to the upside here. I would really like to see that. And maybe people are positioning financial demand because they're scared of a potential recession that could be coming. Maybe that's the case. Here's Grady. I love this chart too, because this is what gold miners follow. It says, posted this chart many times during the last few years, saying it is a very bullish chart for precious metals. Been saying it's climbing the right side of the orange arc, and now it is going for the big breakout above the red line. This is gold priced in the U.S. Consumer Price Index. It's inflation-adjusted gold. This is what the profit margins. This is basically you're charting the profit margins of the miners. So he's got gold as a proven long-term hedge against inflation, but shorter term it can deviate. So we want to see gold outperform the Consumer Price Index. Here at gold, 8-year cycle low is where we bought all the larger gold miners at the service. Later, we brought other categories when they bottomed, and MACD looks bullish still to work its way on up. So if gold outperforms the Consumer Price Index, I am hoping that the mining companies really start to outperform here. That's what we've seen. We've seen pretty big returns in the portfolio of our gold and silver mining companies. Here's BTC, Bitcoin, the 2-week MACD bull bear cross. Keep it simple, friends, for JT. So we've got a bear cross coming up, and we also have a broken uptrend line. Is this going to break lower here for Bitcoin? I look at the bears information. I look at the bulls information. I share both on whatever charts I can find. Is this a double top? 2021 top and 2024 top. I don't know. We'll find out. Breakwave says the trajectory of VLCCs from the summer lows depends on Middle East crude production. Totally agree there. A 1 million barrels per day jump will take place in September and another 1 million increase in November, which should bring 30 VLCC cargoes back into the market. That could take rates to more than 50,000 per day from less than 25,000 currently. And after all, the supply side factors in the VLCC sector are there to allow for a tight market. And that's Omar Nakhta of Jefferies at TradeWinds. I think this is a huge opportunity, and I think that the tankers look absolutely excellent. If you're looking to take advantage of this, I think I know what the best tankers are to take advantage of this. I'm spread across 3 different ones. Big dividend yields too. Another one from the Great Marty. I know he's pretty bearish on everything, but silver update. This is something he's bullish on. The 4-year chart break is significant. The longer the sleeper, the more powerful the move. Backtesting the break before resumption is textbook behavior. There's the sleep, the breakout, the retest, and then the potential move higher. Today, we had a very big move in silver, up about 3 point something percent. This could be starting that upward move. Warren Buffett says, good investors are data-driven and enjoy the game. They are people doing what they love doing. It really is a game they love. Here's Warren Buffett's cash stockpile. It says cash position relative to total assets spiked to 25% in Q2 of 2024, the most in at least 24 years. The company's share of cash has more than doubled in the last 2 years. To put this into perspective, the company's cash pile to total assets reached 24.5% in Q2 of 2005 and remained elevated until 2007. Cash and cash equivalents and short-term treasuries held by Berkshire Hathaway spiked by $88 billion to a new all-time high as $277 billion in Q2 of 2024. Is Buffett turning bearish here as he's raising cash? I would be raising cash out of technology stocks too, but that's me. And that's what he's selling. The blood indicator is very close to cross at 100-week moving average. I hope this time is different. So the blood indicator, which is the U.S. 3-month Treasury bill divided by high yield spread ratio, is starting to turn over. Last time it did that in 2000, 2001. It did that in 2007, 8. It did that in 2019, 2020. And it's doing it right now. So this is indicating that we could see a potential slowdown in the S&P and maybe the NASDAQ. This is our 4-week average U.S. oil production, and it does look a little bit toppy here. Is this going to move on down, or are we going to make new all-time highs? I think I shared this one last time, so that's where we'll stop it. But that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We do have a Saturday question and answer session at 7 a.m. Mountain Time. See you guys there. This is Finding Value.